Good morning everyone and welcome to Pengana's Absolute Return webinar. My name is Damien Crowley, Head of Distribution, and with me today is Vikas Kumra, the Co-Portfolio Manager of our Absolute Return Asia Pacific Fund. Vikas is usually based in Singapore but down in Sydney today with us, and I'll be passing over to Vikas very shortly. If I just take you to the first slide titled Correlation of Asset Classes in a Market Crash, I think the relevance of this type of strategy for you and your clients is very topical given the performance of markets and the volatility of markets obviously over the last 3 months and during 2015. This slide is really just looking at the performance of the ASX 300, the A-REITs in Australia, the Barclays Global Aggregate Index in terms of bonds and credit, and then a balanced portfolio. And just a couple of points, obviously you can see the correlation between these various asset classes during this downturn, and that's fairly typical, that correlation, fairly highly correlated. And you can also see the extent of the downturn and the drawdown on client portfolios if they were just exposed to these type of strategies and to this beta. Just on the next slide, so why absolute return investing? I mean, these strategies are designed to perform at different times, and our strategy is designed to help protect the downside. This slide shows you the drawdown from top to bottom for the A-REIT, Australian A-REIT market, the MSCI World, so global equities, and also Australian equities, the ASX 300. And you can see that in the different colours, and then our fund is in the orange. So you can see that the fund has protected capital during these large market drawdowns, which is what it's designed to do, and Vikas will tell you and explain how the fund does that. I'll now pass over to Vikas to take you through an update on the strategy and a couple of case studies on positions that we're trading at the moment, and then I'll come back and wrap up for you. Thanks, Vikas.
Thank you, Damien. Good morning, everyone on the call. If you look at page 4 of the presentation, just a very high-level overview on how we actually generate absolute returns. As far as this fund is concerned, our stock picking is very much bottom-up. So the returns are derived from a particular event or a corporate announcement that has been made to the market. We do not take a directional view on the markets. We run a very tight net exposure, in averaging between 0 to 10%, and we actually manage actively our residual beta in the portfolio by using derivative instruments such as put options on the market and index futures as well. So the key message here is that this strategy returns are really driven up by bottom-up stock picking and around a particular event which has been announced on the market. If I just jump on page 7 of the presentation, that gives you a high-level overview of the key sub-strategies of the fund. Mergers and acquisitions makes up a significant portion of the book. In this sub-strategy, we identify companies being acquired and the price inefficiency around an announcement of an acquisition. For example, the recently announced Oil Search transaction overnight is provides very unique trading opportunities where returns are driven by a particular event. Outside of M&A, we are also active in holding companies arbitrage. This is particularly relevant in Asian markets, which are characterized by very complex structures where listed parents own listed subsidiaries, and dislocations such as the one that we've been through provides extreme price inefficiency where we are able to capture returns which are completely uncorrelated to the direction of the market. Within capital management initiatives, the fund identifies companies undergoing any kind of balance sheet event. This can take the form of a special dividend, capital return to shareholders. But the key message here is in all of these sub-strategies, the underlying returns are driven around a corporate event, which results in short-term price inefficiency in the market of these companies, which the fund then exploits through a long-short approach and bottom-up stock picking. The universe is fairly wide across Asia, and there are many underlying themes which are driving opportunities, and we'll go through that on page 5 of the presentation. These are the 5 major themes which we feel present very, very attractive trading opportunities in the foreseeable future. I briefly touched on holding companies in the earlier slide, but what's really driving the price inefficiency is a lot of these companies are planning for generational changes. And in doing so, are undergoing corporate activity which present very, very unique trading opportunities. some of you may have read about the recently concluded merger or high-profile merger in South Korea involving the Samsung family. That's a true indication of the extent of dislocation, which is very, very prevalent in the North Asian markets in particular. Secondly, Japan's a very unique market for us at this point in time. As part of the third era of Abenomics, there's increased focus on balance sheets and the inefficient use of balance sheet of Japanese conglomerates. The increased focus to make them more efficiently run involves a lot of capital being returned back to shareholders by way of dividend or on-market share buybacks. Or Japanese companies are even becoming very, very experimental in actually using that cash in pursuing inorganic M&A growth. These corporate activities tend to take time to be fully priced in by the market, and the short-term pricing inefficiency is where the fund exploits. On China, there's been an increased focus on state-owned enterprise reform, and it's become much more topical after the recent equity market sell-off in China as well. The recent volatility has resulted in increased focus on companies in China to expedite state-owned enterprise reform, primarily because 70% of the Shanghai Composite Index is actually made up of state-owned enterprises, and undertaking reform by way of M&A, consolidation, or restructuring actually provides the true support for the market to rally from here on, as opposed to government intervention, which we think is short-term and misplaced. And lastly, we are also seeing a return of private equity interest in some markets, particularly markets like Australia, and that is igniting a fair amount of M&A interest. So as you can see, there are structural changes undergoing many markets in Asia, and it's a very well-diversified approach towards exploiting these opportunities across the region. So on page 6 of the presentation, it gives you a high-level overview of the extent of opportunities that the fund is able to exploit. You can see that this is a very well-diversified sub-strategies in the sense that the opportunities within M&A, CAPM, earnings, and holding companies work well in different market cycles. So the fund is then able to exploit these price inefficiencies depending on the market cycle we are in. And generally, to summarize, a lot of these trades are spread compression trades in the sense that we do expect mean reversion and the pricing inefficiency to self-correct over time, and this inefficiency usually is a result of short-term dislocations in the market. And in terms of how we screen for these opportunities on page 8 of the presentation, the fund employs very, very robust internal proprietary tools and also has access to third-party databases which provide or allow us to undertake complex data analysis. So we screen for all these events across Asia as they get announced to the stock exchange. So the fund does not speculate on any deal activity or rumors on the market, but our involvement is primarily post a particular announcement. We then quantify the payoff of a particular trade, identify the upside and downside, and usually get involved in trades where there's a strong positive skew in capturing price upside versus managing downside for our investors. And the portfolio construction takes into account the risk-return profile of each trade. And on the residual net exposure, and in the construction of the portfolio, as I mentioned earlier, it is very, very much bottom-up, in the sense that we have a long and short position against each underlying event, but we do also actively manage residual beta through the use of derivative instruments such as put options and index futures. So what this means is, we spend a fair amount of time undertaking fundamental research on a particular event, but we also do spend a considerable amount of time in risk management and in also managing downside for our investors. Just to give you an overview of the kind of trades that the fund does, page 10 and 11 of the presentation, would give you some recent trade examples that we've undertaken. But I guess for the benefit of all listeners, I'd like to actually touch on a recent trade example in the Australian market, which is of interest to us. Some of you may have read about the hostile takeover for Affinity Education. So that's a trade that came under our radar when G8 Education lobbed a hostile takeover for the company some months ago. And since then, there has been some interest by, or competitive interest by other parties willing to acquire Affinity Education at a higher price. So when the 80 cents a share offer was lodged by G8 Education, the fund actually acquired shares at 81 cents on the market, where we could actually quantify our downside being 1 cent a share from the 81 cents to the 80 cents downside of protection provided by the G8 offer, while we felt at that point in time the market was completely mispricing the upside potential from a competitive bidding situation. And true enough, since then we've seen a situation where Anchorage Capital has offered 90 cents a share, or 9 cents higher than where the fund actually acquired stock, and that resulted in a 9-to-1 payoff ratio, which was positively or very strongly skewed towards the upside. So we tend to identify companies which have announced deals. We quantify the payoff associated with any upside or downside associated with that particular transaction, and then we capture that price inefficiency, as you can see is the case in the Affinity Education trade. And that, by the way, was last month when the Australian market actually sold off almost 9%, but this position in Affinity Education actually appreciated in value. So you can see that returns from these trades are completely independent from where the equity markets trade. And in terms of how the portfolio is constructed on page 13 of the presentation, I mentioned earlier that we spend a fair amount of time on fundamental research and also a considerable amount of time on risk management. We are very mindful of the liquidity of the underlying positions. We've got strict liquidity restrictions in the sense that we can liquidate the portfolio in the event where we need to unwind it. We do not get invested in illiquid instruments. The underlying holdings of the portfolio are primarily listed equities on the long and the short side. We actively manage our exposure, both the gross and net exposure, to ensure that we have a lean portfolio which is uncorrelated to the general market environment. How do we do that? On page 14 of the presentation, firstly, the fund is very diversified by strategy and by geography. We are not overly reliant on one particular market. This is a Pan-Asian fund which trades all of Asian markets, including Australia and Japan. And we are also diversified by strategy. So we have the ability to move away from one strategy into another strategy and construct a very well-balanced portfolio. Secondly, on gross and net exposure, the funds historically always maintain a very tight net exposure of 0 to 15% band. In fact, in this environment, we are running a very neutral portfolio, and we actively do this through, as I mentioned a while ago, the use of derivative instruments. And in gross, the fund is not overly leveraged. We, on average, in the past, have run a gross exposure of about 160%, and presently, we are running a gross of 200% because the opportunities are very, very rich across whole of Asia. But we do not run a very leveraged portfolio in that sense. And on tail risk management, this goes in line with our active management on net exposure. We use derivative instruments like put options, which provide us downside protection during equity market sell-off as these put options become in the money. And we've also got very disciplined approach towards stop losses. We have a soft limit of 50 basis points on each trade. If a trade gets stopped out, we have an internal risk discussion, and a decision is made whether to unwind it from the portfolio. And lastly, just to summarize, as I mentioned the few points a while ago, we are very mindful of liquidity and leverage management of the portfolio. On page 15, we'll give you the true extent of diversification that the portfolio has. We have plotted the graphs here by sub-strategies, and you can see while M&A continues to remain a critical portion of overall gross exposure, that the breakdown in overall gross can change through market cycles. We are mindful of the fact that some strategies work better in some market environments and some strategies work less well in certain market environments. The portfolio is liquid enough and nimble enough to react to the macro environments and tactically adjust our gross exposure accordingly. On the next slide, we've actually plotted a snapshot of the portfolio of July. So this should give you the true extent of diversification by geography and by strategy, which I touched upon a while ago. you can see that in terms of gross exposure, the key markets for the fund are Australia, Hong Kong, China, and Japan. And in terms of net exposure, as of July, we were running a net of 11%. But because of the recent volatility that we've seen in August, we've brought the net exposure down to 0. So we've reduced net, and the book is net neutral at this point in time. And in terms of geographical allocation, we've also brought the gross exposure towards the China portfolio lower. So right now, the two biggest markets for the fund are Australia and Japan. So this nimbleness and the liquidity of the book allows us to react to macro environments. So unfortunately, in July was a challenging month. The fund performance for the month of July was negative 4%. Which was considerably still better than in August. The performance for August was negative 4%. But these are mainly mark-to-market losses which the fund has taken on the back of certain dislocation in some spreads we are involved in. But it is our expectation that over the next couple of months, we should be able to recoup a significant portion of that back. I'll hand it over to Damien, who will then take on the presentation from the next slide onwards.
Thanks, Vikas. Just on this summary slide just shows the performance of the fund, some of the risk-return metrics. So since inception to the end of July, the fund's done about 10.6, but I suppose more importantly almost in terms of your portfolio construction, the drawdown's only 4%. Vol is 5.9. We target 6 to 10, so it's at the bottom end of that range. And obviously we target consistency, and it's had about 80% of months positive. You can see that compared to the world markets, the Asia-Pacific equity markets, and the Australian equity markets, much bigger drawdowns, much higher volatility. And obviously, as part of a balanced portfolio, this plays an important part, this fund, we believe. Just on the next slide just to enhance that diversification benefits in your portfolios. This is the correlations, the rolling correlations, and just shows you that this fund is not correlated to the other major asset classes through time. It's fairly consistent, and that's for all the reasons that Vikas elaborated on. These are stock-specific trades, and then at the portfolio level, if there's any residual beta, Antonio and Vikas hedge that out. The next slide is really just the month-by-month performance of the fund versus the Asia-Pacific equity markets. It shows you the month-by-month, and then it shows you the yearly performance in the summary. The fund has protected capital and generated good returns each financial year and good positive returns versus the Asian markets. And it's also, when the equity markets have fallen, you can see that typically the fund has preserved capital. And just finally on that point, the next slide is actually from left to right is the largest falls in the world equity markets from when the fund started to the end of July, so ranked in order, and then the orange bars are what the fund delivered during the largest market falls. So you can see in all but a couple of months, and even then only minor drawdowns, the fund has protected capital for years in advance. So just finally, the role in a portfolio, this is genuinely not negatively or neutrally correlated with traditional asset classes for the reasons outlined. It is much lower volatility and different correlations, so the overall volatility of the portfolio comes down. It genuinely increases diversification. This is an alpha strategy, not a beta strategy, and that's why it plays that role. And then just a summary slide. I'll leave it there, and we'll open. I think we've got a number of questions, so I'll pass over to Vikas to answer those questions. Thanks, Vikas.
Thank you, Damien. So the first question is on the clarification of the August return. I must stress that at this point in time it is an estimate because the administrators are still working through the NAV calculations. But the negative 4% return, or the estimate of the negative 4% return is in Australian dollars and not in US dollars. I hope that clarifies. Any further questions?
No? Okay, look, if there's no further questions, we might leave it there. Obviously, you have ongoing access to the presentation and everything, and you can always call us if you want any more information on the fund or the performance. Thank you for your time today. I look forward to speaking soon. We've had one question come in.
There's one question on whether there's an uptick in correlation to the bond markets recently. No. The fund's underlying strategy is equity long short. We have no high yield instruments in terms of equity exposure in the portfolio. The returns in the last few months were really driven by, or the negative return last month was mainly driven by volatility in the Chinese market, which resulted in short-term dislocation. So just to clarify, there is no correlation in the portfolio to the bond markets.
Yeah.
And in terms of what is our expectation when Fed start raising rates, just following on from the second question in terms of bond markets, we have a very tight net exposure. We feel that equity markets in the medium term would have a fair bit of volatility around the Fed start raising rates, whether that's in September or early next year. And on the back of that, we've actually brought our net exposure down from 11% to 0. So the book is positioned very, very risk averse at this point in time, and the returns from our underlying trades should not be a result of where interest rates go. As I mentioned, the return profile of each trade is really driven by a particular deal or a particular corporate event. So we do not expect volatility in returns resulting from the Feds actually start rising rates. And in terms of currency hedging, the portfolio is fully hedged at all points in time. In the cash markets or the developed Asian markets like Australia, Japan, Hong Kong, and Singapore, the fund is allowed to run short currency exposure against the long positions that we have in the books, which provides a natural hedge. And in the non-cash markets, where there are capital controls, the fund uses non-deliverable forwards to hedge all currency exposure. So the key message is no, there's no implications on currency markets on returns because the fund is fully hedged at all times.
I think that was some additional questions, but I think that's it. Thank you very much for your time, and look forward to staying in touch. Thank you.